How does one calculate the cost of capital for a business? The cost of capital is a crucial concept in finance and accounting, as it represents the cost of obtaining and using funds from various sources to finance the company's operations and investments. The cost of capital is an important factor in financial decision-making, as it provides a benchmark for evaluating the expected return on investment, ROI, for different projects or investments. Calculating the cost of capital requires a comprehensive understanding of the different sources of funding available to a company and their respective costs. In this article, we will discuss the steps involved in calculating the cost of capital for a business. Step 1. Identifying the sources of funding. The first step in calculating the cost of capital is to identify all of the sources of funding available to the company. These sources can include equity, debt, preferred stock, and retained earnings. The company's capital structure or the mix of different sources of funding will have a significant impact on the cost of capital. Step 2. Determining the cost of each source of funding. Once the sources of funding have been identified, the next step is to determine the cost of each source of funding. The cost of equity can be estimated using the Capital Asset Pricing Model, CAPM, which takes into account the risk-free rate, the expected return on the market, and the company's beta, a measure of its riskiness relative to the market. The cost of debt can be estimated as the yield to maturity, YTM, on the company's outstanding bonds, adjusted for taxes. The cost of preferred stock can be estimated as the dividend yield, and the cost of retained earnings can be estimated as the return on equity. Step 3. Weighting the costs. Once the costs of each source of funding have been estimated, the next step is to weight the costs based on the proportion of each source of funding in the company's capital structure. This can be done by dividing the cost of each source of funding by the total cost of capital. The weighted average cost of capital, WACC, represents the overall cost of obtaining and using funds from all sources to finance the company's operations and investments. Step 4. Adjusting for inflation. Inflation can have a significant impact on the cost of capital, as it affects the real cost of obtaining and using funds from different sources. To adjust for inflation, the cost of capital can be expressed in nominal terms, the dollar amount, or in real terms, the dollar amount adjusted for inflation. Step 5. Reassessing the cost of capital regularly. It is important to reassess the cost of capital regularly, as the cost of obtaining and using funds from different sources can change over time. The cost of capital should be reassessed whenever there is a change in the company's capital structure, such as a new issuance of debt or equity, or a change in the risk-free rate or expected return on the market. In conclusion, calculating the cost of capital for a business is a crucial process that provides a benchmark for evaluating the expected return on investment for different projects or investments. It requires a comprehensive understanding of the different sources of funding available to a company and their respective costs, and a systematic approach to weighting the costs based on the company's capital structure. The cost of capital should be reassessed regularly to ensure that it accurately reflects the cost of obtaining and using funds from different sources. By following these steps, companies can make informed financial decisions and ensure that they are operating efficiently and effectively.